Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The information shared here is for educational purposes only and is not a recommendation to trade.
All right, thanks for joining me this morning. Good morning from Chicago. It's 7:49 a.m. Sorry about the late start. There's just a lot going on here this morning. This is episode number 2707. It is the 27th of October, the last Monday of October of 2025 today. Lots of news over the weekend. Mild risk-on sentiment. You can see that the NASDAQ seeing a pretty good pop there at 1.26% up. The ranges and the volumes, relative range, relative volume is not all that hot this morning, except if you look at grains. If you look at the grain and ag space, it is booming. A little bit better perspective on that is this here. So if I roll this down, we go down to the grains, you can see corn, soybeans, wheat, all popping pretty strong there at the bottom of the list with 160 to 200 to 300% of what we would consider relative range, relative volume. So big deal there. The market's anticipating a deal between the Trump administration and Xi, and they've already alluded to that. So that's the big news today, causing a gap up in the indices, gap up across the board. The government's still shut down. The IFO came out this morning, the German, this important business number, this is the IFO business climate number, was expected at 87, came in at 88.4, so that's pretty good. U.S. and China reached a framework for Trump-Xi talks this week. U.S. tariff increases on China averted. China was said to have agreed to delay a new rare earth exports licensing regime for a year. We bought ourselves a year. Notice how we're always on the edge. Always on the edge. Reality TV. U.S. to immediately raise tariffs on Canada by 10% because of the Reagan ad that was done by Ontario during the World Series that upset Trump. Reagan was shown saying that tariffs, that he's against tariffs and that tariffs have no place in a global economy. And then there's a bunch of other stuff. I don't want to go through the news. You can get this by going to one of the links in the gray box down there in the middle. You can go to Convergence Twitter/X account, x.com/conf trading, and you'll find the same news stuff there. I don't need to go through it. The S&P this morning is in a multi-distribution profile. Has popped higher, but really has done not too much in the overnight session. 24 points basically. The inventory is 100% long, meaning all of the volumes above yesterday's, the prior day's close. But the range so far and the volume's somewhat elevated, but the range so far is pretty normal. So not too much to talk about there. Gold again squeezing against the 4,000 area. This millennial figure has been really important. We'll look gold in a minute, but gold and silver took a big drop last week, and they continue to lick their wounds a little bit. But to me, you know, when you look at gold, really, it's in a pullback. There's not much more to it than that. Let's take a look at the bigger picture in the markets. You'll notice that my trading platform's a little bit different. It's because I've upgraded to the latest version of Edge Pro X, version 7.0.4. Pretty sweet. Lots of cool new features. So it's going to look a little bit different to you here. So what do we have in terms of relative volume? If you look, you'll see that on the S&P, the December contract the delta is pretty much flat despite the gap up and holding above the VWAP. We had pretty good participation on the very large lots, 1,700 contracts so far in the session. I started the platform right at the open. This is MBO data, very accurate. And it's showing us that the very large and large lot traders in the S&P are being offset by the small lot, giving us a net delta, a net cumulative delta of just below zero. Whereas the NASDAQ, we're seeing it lift. Again, the NASDAQ up 1.27%, as it says up here, while it sits on top of its VWAP, above its VWAP, and it's getting lots of love from the aggressors here. We're seeing the aggressor traders in the NASDAQ lifting with price. This implies, what does this imply? It implies that price and the aggression is going in the same direction. It implies very likely continuation. The crude has been a bit of a mess. It's been above and below, and now was below and now above, and we saw a pretty decent lift after the European number, the IFO number. It seemed to lift. And then gold is sluggish below VWAP, full session VWAP on negative delta. So that's the overall cumulative delta picture. The overview, as you can see, we're showing a nice gap here this morning. So we're opening in a gap in the S&P and in the NASDAQ. The NASDAQ's off screen. Let's bring it back to earth here. Both of these products are opening in a gap. Very flat, very poor high on Friday. Very observable poor high on Friday on these products. Man, that's a mess of stuff in there. I need to clean that up, those labels. But the way we finished Friday, I didn't like at all. It seemed to imply that the auction is incomplete to the buy side. The Nasdaq's above 25,400. The S&P is above 6,800, and we're opening in a gap. So what we want to watch for today, given the gap situation, is do we get responsive selling? See how blunt this profile is? Very, very blunt right there. This tells us that this is an incomplete auction, and it gives us a bit of a target to go for if we see that the markets become responsive. The crude, however, it's putting in. Although crude, I was pretty bullish on crude since we tested below the 56 or into the 56. Crude is putting on a rounded top here a little bit, and it's got a little bit of repair. If you look at crude's profile, you can see that it's quite weak here below 61. So we poked below 61 into 60, 67, and have come into 61 again. We want to see on the open here in 2 minutes if we get an open drive into that. If we do, there's quite a bit of room in crude, in my opinion, to the downside, into the 59 before you start getting a little bit of support. The situation in gold, here's the day where we dropped about 8.5% or so, and so we have a drop, and then it's been sideways since. So this looks to me like it's tried to lift, and it's ping-ponging back and forth. The expectation is it's likely to break to the downside. This is a bit of a bear flag that's set up here. However, the catch here is we're right up against all-time highs. So this is a caveat. If this was sitting at the bottom of a downtrend or a market that's been selling, then I would be a lot more confident in the bear scenario. But the way this is, the fact that we've pulled back and all we've done in gold is really to pull back to the monthly VWAP at 4,000. It just snapped back to much higher valuation, much higher acceptance. So I'm not all that bearish gold. Here's what's happened overnight. So you could see that overnight on this 2x8 point and figure chart is just a big old zipper consolidation. We've got two distributions really, but I'm going to tell you that the action in the overnight session does not give me a clear lean or tilt coming into the session. It's kind of sitting sideways. It's done that. It's got a gap beneath it. It's got all-time highs above it, and so to me, it's just it's not an easy read. Here's the map of how things look given our cloud levels, and to if there's any hesitation to the buy side, we do have a relatively blunt highs. We have a pretty weak high. And we have a relatively weak low with a little poke before it pushed up. So if I zoom in here, you'll see that it put in a weak low and then tested, poked below before buyers came back in and lifted it higher to that high. But these highs don't look finished to me, although this is kind of setting up like a spike retest. You could see the high, lower high, very clear bottom or pivot there. So if it breaks below, we're looking for the pullback into this area, into this consolidation, looking for a pullback in there for a short on a gap close trade. And if it does not, if it pushes back in, comes back out, and it's weak and starts pushing back in again, then we have a gap to settle trade. So those are the two key scenarios. I don't want to spend a lot of time drawing different scenarios here. It's pretty self-explanatory. It's straight up, right out of the textbook here. So what's going on here? Straight up, right out of the textbook. So to me, this just looks like it's either going to gap and revert or gap and go. In either case, you have to, my approach on this is I have to wait and see which side really has control, which side has takes over control, and that may take 15, 20 minutes, maybe the entire 30-minute first bracket. Don't be in a hurry. My recommendation is don't be in a hurry to jump in and catch it early on. There's just no need to do that. Just let it figure out what it wants to do. The day is long, and there's a probability here that we'll see something materialize that we can use. But for now, you don't need to go crazy with this. So what's happening? They change. Okay, looks like we've changed my menu. Yeah, I need to put that back on. Okay, so that's the S&P. So the S&P gap and revert, like I said, back into these weak highs. Look at these double, triple TPO highs. Gap and revert. If it reverts and bounces back up and comes back in, fine. But if it reverts and then puts in a lower high and starts running, then we're looking for a prior settle on a runner, right? So that's what we're looking for. Otherwise, it's a gap and go, which means it tries to break down. You get an impulse, takes out the weak high, runs to that 6,900, and then starts tracking into the Vol Sigma up. So we're already stretched. This is the tag for one Vol Sigma up from the prior close. So there is an approximate 70% historical probability that we would close under this line. This is 1 vol sigma here where we are. This is why I'm leaning towards the gap and revert idea as the primary scenario. Okay, the NQ looks the same in principle. You can see there's a gap here, but the NQ is a lot more bullish. I think the NQ is likely to really frustrate some folks. It's quite strong. Even, so far, like, it's got a trend-like profile. You could see this is a very, very strong kind of very strong structure, and it's not backing off its high. Point of control is at the low end of the range. It's leaving its value behind. The NASDAQ may cause the S&P to struggle to revert. It's just there's the S&P and the NASDAQ are kind of disjointed today. And whenever we have that, it becomes a little bit tougher to read what it's trying to do. So I would suggest that if you're in the NASDAQ, just let it show you what it wants to do, but it may turn out to be a breakout type trade today in there. As far as crude, not much more to say. I mean, we've already dropped into the gap. So this is a big gap area. We left a huge gap behind. We've dropped into the gap. We did not get to the gap mid, and then we found buyers. So crude to me looks like it's got a little bit of traction. If crude cannot push and take out Friday's high, then crude is likely in a one-time framing down structure. So if it does not take out the high by the end of the session today, there's likely to be selling flows. And again, 59 becomes the key area. Okay. Okay, so that's it. That's 17 minutes of me babbling along. I want to remind those of you who are maybe new to the TraderBite and so on, what is the purpose of what I'm doing here? The purpose of what I'm doing is very simple. You can trade the market in many, many different ways. You can use indicators and just rely completely on indicators. You can use structure and do that, trade using price action, fibs, things like that. There is no right or wrong way to trade the market. However, I could tell you as a professional trader, I've been doing this for 25 years, I can tell you that through the repeated struggles I've had with the market changing over time, is that not understanding how the auction works, how the market works, makes one susceptible to a sudden and unrecognizable change when we are very indicator based. So I'm not against indicators. I'm against folks who are buying a tool or an indicator and not fully understanding what the theoretical basis of that indicator is. And so you end up with a sort of dependency, which is great for the people selling you the software, the indicator, the product, but not for you as a trader. What is best for you as a trader, in my opinion, is really understanding how the market works. Think in the mind of a program manager at a hedge fund or at an institutional desk, right? Think of what is the market? What has it done? What is it trying to do? How good of a job is it doing? What is it likely to do next? This is what I'm covering. This is why there's a lot of what seems like wishy-washy. It might do this, it likely will do that, it'll probably do this, and there's nothing definitive, whereas others with thousands and thousands of live viewers are much more firm in their view on the market. But the fact is, if you're a professional trader who's got some consistency in a career and pedigree, the fact remains, and it's really unchangeable, that we are trading in probabilities. There's nothing here that makes us an expert. There is no such thing as a master of the market. There is no such thing as a market expert, because the market does not provide consistent outcomes. In order for you to master, to be an expert, there has to be a consistent action that results in a consistent outcome. And that doesn't exist. Doesn't exist in trading. This is why you'll have Jamie Dimon come out and say, well, I think we're heading for a recession, blah, blah, blah. He doesn't say, based on the billions of dollars we spend on researchers and the facilities that we have, we will definitely go into a recession. He'll never say that, because he's a professional and he understands that the market works in probabilities. You have to do the same. You have to operate in probabilities. And so we look at the auction. We look at the behavior of the auction as described by market profile, volume profile, to see where participants are interested or disinterested. And then we layer quantitative analysis behind that. We have these statistics for prior settle, overnight stat, IB stat, IB within IB. What happens if the market gaps up? How often does it hit its gap, half gap? All of these are statistical products, statistical studies. We cover them at Convergent Trading. You get the MSR, the market stats report, and then you can start to think in probabilities and kind of see what's there. Once we figure out what our narrative is in the market, which is what I'm doing with you here every time we have a TraderBite, now my job is to localize a trade in an area where I can define risk. So I have to define risk. I have to define a bias, right? As soon as I define a bias, I've got 3 cards on the table. I have a buy card, sit on hands card, and a sell card. The sit on hands card stays on the table all the time. My job next is to take out the buy card or the sell card and throw it away. If I take out the sell card, then I cannot sell. I'm only a buyer or I'm sitting. If I take out the buy card, then I'm only a seller or I'm sitting. Once I do that, I've established risk, I've established a bias, and now I just need to wait for a setup, and I'm trading a specific set of setups. There's 12 of them. And so I'm looking for these setups, and as soon as it sets up, my job is to impulsively, without thought, put on the trade, set my risk, and then look for my risk scale. As soon as I have a risk scale, not a full target, as soon as I have a risk scale, my risk is covered, the trade is funded, and now it's up to the market to figure out what to do next. My job is to cover risk. All of that is not as sexy as me telling you how to use an indicator while I have a McLaren in the background in a really cool LED lit room. But that's entertainment. That's not trading, and there's nothing wrong with that if that's what you seek. But if you're looking to trade professionally, that's the structure that lasts a long time, in my opinion. That's how robustness exists. That's how longevity exists. If it's as simple as an indicator, I'll automate it and I'll stay in bed and just sleep. But that's not how trading is done. Now, this whole thing that I just talked about really is giving you the Holy Grail. And the Holy Grail is you got to work your ass off. You've got to do the homework. You got to put in the time. You got to learn the market. You got to understand the market. And then there's a point where it just becomes intuitive. It becomes easy to understand what you need to do as part of your process, and it's the process that makes money. It's not the P&L. The P&L is a byproduct of good process and good outcomes, but you don't control the outcomes, you control the process. And all I can do is follow my process and be loyal to it and do it perfectly. That's what a professional trader does. You do that, you can quit your job and whatever. But until that happens, you are subject to the whims of indicators and whatever else. Okay? If you know of any traders struggling, tell them, link to the time slot where I talk about this. Tell them this is what it takes. But I'm not bullshitting you. This is fact. So I could sell you a lot, and I don't sell anybody anything. I can sell you a lot to tell you, hey, come on in, get me the views. I can charge you for YouTube ads. I don't have YouTube ads on my channel. I'm keeping it simple because this is not my business. This is not my main business. I'm simply wanting to have a robust, long-term, healthy ecosystem of traders in futures that stay here a long time so that it can sustain me, my businesses relating to futures, and so on. And we could have an environment of traders that make this fun, right? And that's what Convergent is for. But really, you don't need to be a part of Convergent. If you're able to do this on your own, great. But doing it on your own costs you time, and you have to figure out how much time you have for the responsibilities and the bills that you have to pay. Okay? Good luck. That's just the God's honest truth, and I'm just sharing with you what I know for fact. As I said, I've been here a long time. Hopefully, this will resonate with you. It is the end of the month. Let's start November properly. Make sure you're doing your homework. Make sure you understand what the market narrative is. Make sure you learn what the auction is doing. That is key, because anything that has a price has an auction, and the experts in that field are people who understand auctions. A good real estate broker is only good because of their understanding of the real estate market and what valuations and prices and auctions are going on in there, so they can get you a good deal. A good car broker, a good logistics broker, they understand the auction. They understand supply and demand. Why are you not understanding the auction as part of your trading process? Good luck.